Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Pra Group Inc. Annual Report. Pra Group Inc. offers a diverse range of financial services that cater to the needs of individuals and businesses worldwide. The company's primary focus is on purchasing and collecting non-performing loans from various sources. This includes unpaid obligations of individuals owed to credit originators, as well as non-performing loans sold by credit originators who have given up or been unsuccessful in collecting the full balance. The company's services also extend to providing fee-based services for class action claims recoveries. Additionally, PRA Group is involved in purchasing and collecting on non-performing loans where the customer is involved in a bankruptcy or similar proceeding. Its portfolio of non-performing loans includes various types of debt such as general purpose and private label credit cards, consumer loans, auto loans, overdrafts, and small business loans. Overall, PRA Group services are designed to help creditors recover their losses on non-performing loans while providing a valuable service to individuals and businesses in need of financial assistance. The stock price of PRA Group Inc. has dropped by over -14.75% in the past year due to several key news events. One major factor contributing to this decline is a significant goodwill impairment charge recorded in Q3 2025, resulting in a net loss of $305.1 million for the full year 2025. In addition to the goodwill impairment charge, PRA Group Inc. also reported earnings misses in both CONE and Q2 2025. In CONE 2025, the company's EPS of $0.09 fell short of analyst expectations by -78.05%, while in Q2 2025, its EPS of $0.33 missed forecasts by -46.77%. These disappointing earnings reports likely contributed to investor skepticism and a decline in stock price. However, PRA Group Inc.'s performance improved in Q4 2025, with the company's EPS of $1.46 surpassing forecasts of $0.31. This positive result led to an 8.29% rise in aftermarket trading. Despite this improvement, the overall sentiment and stock performance for the year remain negative, with PRA Group stock down 28% year-to-date and 41% over the past year as of late February 2026. PRA Group Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $1 billion. PRA Group Inc. trades at a higher price-to-book ratio of 0.67 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 76% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, key contributors include the purchase of non-performing loan portfolios from credit originators, collection efforts through call centers and legal recovery, forward flow sales agreements, geographic expansion into new markets, and increased portfolio income and estimated recoverable cash. These drivers have led to significant revenue growth, with an 18.2% increase in portfolio income and a 15.4% rise in ERC compared to the previous year. Additionally, higher purchasing levels, improved pricing, and foreign exchange rate variations have also contributed to revenue growth. Furthermore, forward flow agreements and share repurchases have provided additional revenue streams. On the decline side, factors such as decreases in changes in expected recoveries, increases in operating expenses, and declines in purchase period collections have led to revenue decline. Specifically, a significant drop in purchase period collections in both U.S. core and Europe core has contributed to the decline. Moreover, decreases in purchases of non-performing loan portfolios and increases in operating expenses, interest, and taxes have also negatively impacted revenue growth. Overall, these drivers highlight the importance of strategic portfolio management, effective collection efforts, and geographic expansion in driving revenue growth, while also emphasizing the need for careful management of operating expenses to mitigate potential declines. The net income of the company experienced significant fluctuations between 2023, 2024, and 2025. In 2023, the company reported a net loss of -$83,477. However, this trend reversed in 2024 with a net income of $70,601. Unfortunately, the company's fortunes took a turn for the worse in 2025, with a net loss of -$305,142. The profit margins also underwent significant changes during this period. In 2023, the company reported a negative profit margin of -10.41%. However, in 2024, the profit margin improved significantly to 6.33%. Unfortunately, the trend reversed again in 2025, with the profit margin decreasing significantly. The reasons for these changes are attributed to several factors. The decrease in net income and profit margin in 2025 was largely due to a goodwill impairment of -$412 million, an increase in operating expenses, and a decrease in gain on sale of equity method investments. On the other hand, the increase in net income and profit margin in 2024 was due to an increase in operating income from $120.8 million to $345 million, and a decrease in goodwill impairment charge. Overall, the company's financial performance has been marked by significant fluctuations between 2023, 2024, and 2025. While there were some improvements in 2024, the trend reversed again in 2025 due to various factors. The company's financial performance has shown significant improvement in recent years. One key indicator of this growth is the generation of positive operating cash flow. According to the latest figures, the company generated an impressive $1,315,474 in operating cash flow for the year 2025. This achievement is a testament to the company's ability to manage its finances effectively and generate sufficient revenue to cover its operational expenses. The positive operating cash flow also indicates that the company has a strong foundation for future growth and expansion. With this financial stability, the company can invest in new projects, pay off debts, and reward shareholders, ultimately driving long-term success. The performance of various regions and segments within the company has been mixed, with some showing improvement while others struggled. In terms of positive performance, the U.S. segment saw a decrease in portfolio purchases by 25.9%, but this was offset by an increase in cash collections of 17%. Similarly, Europe experienced growth in both portfolio purchases and cash collections, with increases of 2.1% and 12.6% respectively. On the other hand, several regions and segments underperformed. South America did not have any specific performance metrics mentioned, suggesting that it may be a challenging market for the company. Canada and Australia were also not considered as operating segments individually or collectively, which could indicate that they are not significant contributors to the company's overall performance. The core portfolio and insolvency portfolio both performed poorly due to accounts being purchased at a substantial discount to face value and customers involved in bankruptcy or insolvency proceedings respectively. These issues may require attention from management to improve the financial health of these portfolios. Management is emphasizing a core business focus on purchasing, collecting, and managing non-performing loan portfolios. The company's global business strategy has three key components: capital and investing, operations and technology, and people and culture. Management highlights the company's competitive strengths, including its diverse global presence and strong relationships with credit originators. In terms of outlook, management is focused on strengthening the U.S. platform and building on European business momentum. They are developing a longer-term strategy that prioritizes cost efficiency and operational flexibility in U.S. business initiatives. The company has sufficient liquidity to finance operations for at least 12 months and may seek debt or equity capital markets as needed. Management reports continued investment selectively, focusing on long-term returns and balancing investments with leverage. They also discuss forward flow agreements, share repurchase programs, leases, and derivative financial instruments used to manage risk. Overall, the company is focused on executing its strategy and managing risks to drive long-term growth and profitability. The company has made several strategic moves through acquisitions and divestitures to shape its portfolio. In terms of acquisitions, the company has purchased non-performing loan portfolios as a result of business acquisitions or purchases. This approach allows the company to expand its assets while minimizing potential risks associated with these loans. Additionally, the company has entered into forward flow agreements for the purchase of non-performing loans. These agreements provide a steady stream of new assets and enable the company to manage its risk exposure more effectively. It is worth noting that there have been no divestitures mentioned in the extracted summaries. This suggests that the company's focus has been on growing its portfolio through acquisitions rather than shedding existing assets. The company's ability to distribute wealth to its shareholders through dividends and share buybacks is limited by certain agreements. Specifically, covenants in credit facilities and indentures governing senior notes restrict the company's capacity to pay dividends, page 16. This suggests that the company may not be able to provide a return on investment to its shareholders in the form of dividend payments. Furthermore, there is no mention or indication of share buybacks in the provided information. The absence of any reference to share buyback programs on page 19 and page 63 implies that this option is also not available to the company. As a result, it can be inferred that the company has not bought back shares. That concludes the financial summary for Pra Group Inc. Feel free to comment below, and I will be happy to answer them when possible.